Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com.
We've posed this question before. We're going to pose it again. Given the market's recent rise, if you were given a batch of fresh cash or you all of a sudden came into some money, where would you be putting it as far as investing is concerned? And our analysts weigh in here at the roundtable. There's Steve Reitmeister, who's our editor-at-large, our senior market analyst, Charles, the main Twitter for Zacks Roadblock, and Kevin Matris, our top stock screener.
And that's twitter.com/Charles Roadblock.
All right. If you'd like to follow his suggestions or anything else that he might have to say, then you need a life. No. All right, but we're going to start this out with Kevin. Okay. And we're going to focus, each of you are going to focus on different time horizons this time, and you're going to give specific examples this time.
Yes.
Right?
All the above is true.
Okay, so Kevin, you on the hot seat first.
Okay.
Your focus is going to be 1 to 3 months, the very short term, which is more trading than investing, right?
Yeah. I have my notes in front of me, so let me see if I can begin.
Okay.
My outlook for the short term is cautiously bullish. I do believe we could see the Dow get to 9,500 or even 10,000, maybe even above. Because, let's not forget that we are right now at 8,500 in the Dow. Mm-hmm. This is an area that people were only dreaming about just a few short months ago. Mm-hmm. Now, I do believe that there could be a correction along the way, so I am not suggesting that this is going to be a painless ride. We're seeing a correction today. And what's interesting is that even the small correction can be quite painful because the memory of that, one of the worst bear markets we have ever seen is very fresh in our mind. But the reason why I think 9,500 and 10,000 is realistic because the economy indeed is getting less bad. Earnings are getting less bad. In fact, some earnings are downright fantastic. I do think Q2 is going to be very important, but again, we had looked at the abyss, and I believe the market had flatly rejected it. So let's think about this. What somebody has to do is they have to ask themselves, if we are at 8,500 and this is where we were back in November and December of last year, at that point, everybody thought the world was going to come to an end, and we saw the market then proceed to fall another 25%. Recently, we have erased those losses, and we are now right back to where we were. So, are we in a better position now than where we were back then, or are we in a worse position now than where we were back then? I would argue that we are in a better position in regard that we can now see the light at the end of the tunnel. So I really do believe that seeing a 10 or even a 20% gain from here is very realistic. So, what should an investor do? I believe an investor should get into the market. I believe an appropriate allocation would be anywhere from 60 to 75% in at this point. I would be buying corrections, not panicking at corrections. And I think the best way to go is to focus on companies that have the best average Zacks rank industry. The reason why looking at the top industries according to the Zacks rank is because studies have shown that the top half of the Zacks ranked industries outperform the bottom half of the Zacks ranked industries by a significant margin, roughly 4 to 1. And I think that is spectacular. So, I think if you were to look at some of the industries right now that are firing off, that are looking the best, you have retail. And in the retail segment, you've got auto part dealers, you've got supermarkets, apparel stores, restaurants. Two such auto part dealers that are coming up are AutoZone, ticker AZO, and you also have O'Reilly's, O-R-L-Y. A lot of people probably are not paying attention to this area, but it makes sense, especially since new car purchases seem to be on the decline and people are putting more money into the cars that they have. Also, you have healthcare. Healthcare continues to be one of the top industries that comes through. You're looking at pharmaceutical companies and even outpatient home health care and this kind of thing. A couple of examples would be Novin Pharmaceutical, ticker NOVN, and Rehab Care, RHB. Also, too, you're looking at some heavy construction companies coming through as well. Don't forget, we have a lot of stimulus money coming down or coming into the economy very, very soon. One stock that has been doing great, that has a fantastic Zacks rank, is a ticker called GLDD, Great Lakes Dredge and Docks. So there's another great stock. And also, too, I think we should take a look at tech, the computer software industry, and these types of things. So this is a great place to look, and I think that if people pay attention also to top-line growth and bottom-line growth, I think they will put the odds in their favor.
All right, and the today that he referred to is the 8th of June, 2009, the day that we're taping this roundtable. Well, that's all we have time for.
Hey, that was about 2 or 3 minutes. I think I got it to 2 or 3.
Steve, you're going to cover the intermediate term, 3 to 12 months. I'm taking notes here, too, just in case this TV thing doesn't work out for me.
So now we're just trying to stretch it out, and kind of like we have the trading scenario. He's going to take like the long-term, almost buy and hold type investor. So I'm kind of somewhere in the middle, what I like to think of like as the opportunist, a guy who sees an opportunity, and sometimes it only takes a few months for it to play out. Sometimes it's a whole year. But that's the kind of range that I'm talking about. So here again, first you got to set the backdrop of what does the marketplace look like? Do I want to be in this market? Do I not want to be it? Or do I want to be long or short this market? And Kevin had referred to some good reasons why the market should stay aloft. My continual focus on earnings. I will say that finally that's one of the things that is looking better as well. The earnings estimates for the S&P 500 have been slipping for a year, okay? And finally we see this little turn up. Now hopefully it stays at least flat or continues to rise a little bit. This is very good that the analyst community is finally seeing that the earnings are firming up. They may be more real and may be slightly improving. With the earnings estimate of the S&P 500 next year at about $74 per share, that means that the market is currently valued at about 12.5, 13, as far as a PE. That is not outrageous for the marketplace at this time, okay? And I think it certainly supports the case that 6,500 on the S&P, on the Dow is a reasonable bottom. And I'm not saying that we're going to go shooting higher like Kevin. I think we have to stay in a range here for a while, build up some support, see a little more green shoots blossom, and then we can go higher. But what I'm saying is there is reason that the bottom is probably in. There is reason to be in the market. I'm surprised that you only took 65, 70% long the market. I'm pushing it more towards 80. I think that a person should be in the market. And the remaining 20%, whether that's shorting the treasury bonds, which I think is a great way to go, or if you want to dabble in gold, but some cash or cash type substitute, that's fine. So 80% in the market. So where are the places to look? Kevin mentioned a couple of those industries. Healthcare, whereas defensive, there's also the fear that the government's playing around that space too much, which makes it a difficult place to make money. But folks like generic drug makers like Teva, T-E-V-A, have a decent chance to be successful in the current environment or even in a regulated environment. They should do well. Retail, as long as you stay, in my book, still towards people who are a little more in the discounters or specialty. So for me, Target is one of those who does a lot of staples, but also just borders. They have some discretionary, and so any uptick in the economy, and Target should play well in that space where people are still cost conscious, but maybe want to spend a couple more dollars. And then, technology has the healthiest earnings estimate revisions. And I'd stay away from some of the more speculative places in there, but folks like Research in Motion or an online player like Shanda, these are two firms that have clearly had good earnings coming into the recent economy, and Shanda just had a phenomenal earnings report and upward estimate revision. So these are two that I think are well poised. So I'll just wrap it up with this. Do not get too speculative with those positions. You want companies in healthy industries who have real earnings from the past, that if there's a downturn, the earnings will support their valuation, and if the market continues to go higher, people will always be attracted to companies with good earnings.
All right, Charles, that gives you about a minute and a half to take the 12-month plus view.
Well, I think when I started writing this, I thought, well, what if someone's been standing on the sidelines this whole time, been afraid to do anything? And I think if you're that person, or maybe if you just start dabbing into stocks, I think you need to think over the next 12 months, how are you going to get back fully in the market? And I think if you look at a combination of stocks and bonds versus sitting in all cash, I think 12 months from now you should be completely invested. That does not mean right now. It means dollar cost average over a period of months, several months. But I think starting off with someone who's kind of starting with a clean slate, or maybe their portfolio is a disaster and they're realizing they just have to sell everything and start from the beginning. Two areas I would start off looking. One is I would look at the BRIC countries. You can look at Brazil. You can look at China. They're going to have stronger growth than we will have here. India, possibly with the new elections, they should show some stronger growth. One ETF to get exposure to all of them is EEB. It's about 50% weighted in Brazil, about 35% in China. Alternatively, there's several country-specific funds in there. A little nervous about Russia because you always have the political risk there in Russia by itself. I would look at technology. Steve just mentioned research in motion. We added that to the Zacks Elite Focus list last week. I love large cap technology. I think large cap software, because these companies are going to have to figure out, well, companies in general are going to have to figure out how do we actually make things more productive? How can we get more out of our workforce? So I think there. But I think if you step away from that in terms of a more general portfolio, I do think you need to look at retail, start dabbing in finance, either like credit card companies such as Visa, or start looking at some of the companies that might be able to get out of a TARP, such as Goldman Sachs. I think you need to look at retailers. I think healthcare is actually discounted for a worst-case scenario. And I think when you look at the providers, it's important to realize more people getting health insurance means more business for them. We do have a shortage of doctors and hospitals, so you will see actually those companies profit in there. Would look at commodities, even though we've had a recent rally, maybe look for a pullback. Demand for oil and agriculture is not going away. We'll actually see more demand for that. There's various funds that go into that as well, DBA, DBB. But I think you also, just in a general thing, you need to look at small cap growth funds. Small cap growth will lead us out of, if there is truly growth coming back, that'll help us. And I think as a hedge, you might want to look a little bit at corporate bonds and looking at both shorting the long bond, but also buying treasury, inflation-adjusted treasuries. That way you get the benefit of higher yields by shorting the long bond, but you also have some cash that's more conservative. But if inflation should kick in, you actually get a higher yield as a result on your investment.
All right. And do any of you own any of what you mentioned, stock or fund-wise?
I probably own everything I mentioned.
Okay.
I own quite a bit of what I mentioned, including shorting the treasury bonds.
Okay.
The ones I mentioned, I don't.
All right. There you have it. 3 different views on investing if you had some fresh money to put into the market, depending on your time horizon. With everybody here, I'm Terry Ruffalo.